Welcome to the Techno Fundamental Report for April 13th. To sell your soul. These guys sold their soul. This is Robert Allen Stanford. He's spending 110 years in federal prison for a Ponzi scheme that hit Baton Rouge pretty hard. It hit our area for about $1 billion, of which about $800 million was Exxon retirees. Now what happens is we get a bear market. This is the '08 bear market. And investors start kind of looking around for things other than stocks. And so that's where they start looking for a panacea. There is no silver bullet. There's no panacea. So the latest thing that is going on right now is Bitcoin. And you know, Warren Buffett is one of the most successful investors of all time, and he's saying stay away from this stuff, that it's basically nothing more. Well, Jamie Dimon said it's nothing more than an indication of money laundering. But this kind of stuff pops up during bear markets, so just be aware of that. Now, I wanted to review a book. There's two books. One is The Psychology of Money. Now, Warren Buffett also has a reading list, and on there, one of his top books is called The Outsiders. These are both excellent books. Now, on The Psychology of Money, one of the things they refer to in the book is that J.P. Morgan study of 3,000 stocks over a 25-year period. And what was really interesting is that 40% of the 3,000 stock components lost at least 70% of their value and never recovered. So let's go look at a couple of the big winners that were listed in the book. Actually, on page 35 of the study, they list the 7% that were the top performing stocks in the 3,000 stock database over the 25-year period. One was Cisco Systems. Now, Cisco, we first started understanding Cisco back in the mid-90s. And you can see here, this is the dot-com rally where everybody and their brother were day trading. Then the crash came, the dot-com crash came, and then look at how long it took Cisco to get back to those prior levels. It took about a decade, you know. So technical analysis really comes in handy when you're looking at something like this. You say, you know, this stock is consolidating, moving sideways, therefore no action. But then if you start to see a breakout, especially on heavy volume, which is buying volume, that would be the opportune time to start looking at this stock. Now, it's no coincidence. The market bottomed on March the 10th of 2009, and the market went into an uptrend. So as we look at these stocks, you're going to notice, you can't help but notice, they all broke out of trading ranges when the market turned up. So the key to this thing is we've got to have an uptrending market, which I think we're starting to see. We're seeing the early stages. But this is Amazon. Amazon went public back in '97. You can barely see what's going on with the peak, but then look at how many years it took to get that stock to break out. Here's Apple, same story. Now, I happen to have volume on here, but you can see the uptrend of the market, and then you see simultaneously you get an uptrend in the stock. So uptrending markets are important. Here's Microsoft, same story. Uptrending market, stock breaks out. But look at all the years you had to wait. So I think technical analysis would have really helped you here. Now, one thing that everybody's talking about is the fear of recession. Now, one thing I will say, I have never in my career of 50 years, or going on 50 years, ever seen a recession that's advertised. It always seems like you get like a crash of '87, or you get the dot-com bust, or you get the financial crisis, and it just kind of comes out of the night, and really no one even predicted it. Well, everybody's predicting recession. Now, this is a report that is all employees total non-farm payrolls. And you can see here, and this is current, you know, I don't see a recession. I mean, unless this turns down. Whereas you go back and look at prior recessions, this is what the payrolls were doing, you know, and unemployment was going up and so forth. This is the COVID situation, you know. But looking at this, it's kind of hard to argue that we're going into a recession. Maybe we are. Who knows? But It sure is advertised, and I've never seen that happen before. I really think this indicator is important. This is the power index. Let's go back and look at it one more time. You can see here what's going on is this is the 5-year Treasury note. The yield got down to, 1.5%, 2%. And basically what happened, now the thing to realize about interest rates, it's not the level of the interest rates that's important. It's the direction. So what I've got down here is something called rate of change over 125 days. That's roughly 6 months. And so what the bond market does, in my opinion, because I think it's very efficient, I am an efficient market person, you can see here that back in November of 20, this was a warning. This was telling you, when it crossed back above zero, this was telling you that the Fed was probably going to have to start raising interest rates. And then you can see what happened. I mean, we went to a plus 250. Now, exactly the opposite is happening now. In other words, this is saying now that it's dropped below zero and it's at a negative 16.62, that the Fed is probably done with raising rates. We'll just have to see, but I will say you have two types of interest rates. You have one that are man-made, which is what the Fed funds rate, and then you have the market rate, which is the free market. Well, the free market right now is discounting, and as you can see here, rates are really starting to come down. Now, if you look at this is the aggression index, which would make sense to work simultaneously with this indicator. In other words, this indicator gave a warning back in the fourth quarter of 20, whereas the aggression index gave a sell signal in the first quarter of 21. So it basically was saying that the big institutions were moving their money out of aggressive type stocks, meaning technology, and they were moving money into the consumer staples sector, which is defensive. So this was also a warning, but these are leading indicators. They're designed to lead you. Now, as we stand today on the aggression index, we're on a buy signal. However, it's starting to kind of, base out here. So hopefully we get it going back this way. But right now it's basically saying kind of keep things cautious right now. Now, as you can see here with interest rates, this is the 10-year Treasury note. A breakdown below the 200-day moving average means that interest rates are in a downtrend. So you define a downtrend this way. What was the last major event? Well, the interest rates made a low. Have they made a high since that low? No. So it's in a downtrend. Oil prices are starting to kind of firm up a little bit. We're seeing them ever since OPEC announced they were cutting production, but we're still not above that 200-day. Financial stocks are starting to stabilize. That's some very good news, by the way. The other good news is that the S&P 500 and the NASDAQ are holding above the 200-day moving average. So it does look like the NASDAQ is basically trying to get going into an uptrend. Same for the S&P. Now remember, Ron Johnson, who founded Fidelity Funds and actually trained Peter Lynch, who ran the Fidelity Magellan Fund, if he was asked if he was on a desert island and could have one stock market indicator, what would it be? And he said the 200-day moving average, which I think is an important moving average. Now let's take a look at a stock. This is an interesting situation. This is Palo Alto Networks. They primarily provide firewall appliances for cybersecurity. So this is a cybersecurity situation. You can see here back in February, we got a massive amount of volume, about a 20 million share day on an earnings announcement. The stock gapped up. Now it's been basically stabilizing. Now it had trouble holding that gap, but then it's gone back into an uptrend and is turning up as we speak. So Palo Alto's pattern is, a buy signal, consolidation. What we would like to see would be a move above 200. Now their numbers are good. They're not extremely profitable right now, but sometimes this happens where companies have a bunch of expenses that they need to incur for the future. So the profit margin is not very good, but the return on equity is decent. But most importantly, the cash flow is positive. In other words, they've got $2.1 billion coming into the balance sheet, after debt payments. And so the point there is now their revenue was up 26% in the most recent quarter. Now their earnings are difficult because they had negative earnings. Now they're having positive earnings, so it's kind of a infinite number. Cash is $3.3 billion. They've got some debt, a pretty good bit of debt. The current ratio is not as high as I'd like, but the main point I am making is when you've got that positive cash flow, that's a big deal. Now the CEO, let's just take a quick look at the CEO. His name is Nikesh Arora. He's got tons of experience. He's been in the industry for many, many years. Very educated, and basically he's involved. He's an engineer, and you want engineers running your company because they have a tendency to promote new inventions, which means new products, new services, and gives you new growth prospects for the company. But anyway, if you have any questions, please let me know. Thank you very much.